book, Chapter 9, Understanding Common Stock. And just as an author's note, I'm posting a text version of the entire book on Substack, which you see here, and video versions on YouTube on one single playlist. So you can email me here for details on my fifth book's publication date in late 24, early 25. So I drink 2 sodas each day, which concerns my wife, and she sends me articles with titles like 10 Reasons Why Soda is Killing You, which is subtle. Many investors own common stock, and I'll explain the different types of stock, the different types of accounts that are used to own stock later, because you can buy them in different forms. Maybe a retirement plan, may not be. For now, I'll explain the basics of common stock using PepsiCo as an example. How companies raise money to operate. There are 2 basic ways that companies raise money to operate: issue debt, sell stock to the public. The money they raise is referred to as the company's capital. Most of the investments you'll consider are some combination of stocks and bonds, mutual funds, ETFs, etc. Years ago, PepsiCo issued common stock to the public for the first time. If Sally, our investor in this book, purchases common stock, she'll become an owner of PepsiCo. She'll become a shareholder. And she has some rights as a shareholder. Voting rights. Shareholders vote on major business decisions like electing the board of directors or approving a merger with another company. Major decisions. PepsiCo sends Sally documentation that allows her to vote her shares at the annual meeting. She doesn't have to be there. She can vote without being at the meeting. Cash dividends. Dividends are a share of company profits or earnings. And if PepsiCo may pay a portion of profits as a cash dividend. However, the company does not have to pay a dividend, and many companies retain or keep profits in the business for use in the business to pay for expansion. Stock dividend. Companies may reward you as a shareholder by issuing more shares of stock to existing shareholders. For example, you might receive 1 share of stock for every 10 shares you own. I'll cover more on stock dividends later and what the impact is financially. Finally, you have a right to sell your common stock. You can sell common stock on most business days. It's becoming easier and easier and less expensive to do this. Shareholders can profit by selling a stock for a gain. If you hold your common stock for years, you can earn either a cash dividend, a stock dividend, or both, so you can profit by receiving dividends even if the stock price stays the same or declines. It's important to know. Stock and company liquidations. Common stockholders are last in line to receive assets if a company liquidates. Now, that's unusual, but it's a topic you need to know. If a company is forced to sell all of its assets, who gets the money when they sell all the assets? Secured creditors. Creditors own an interest in a particular company asset are paid first. If a bank has a mortgage on the company headquarters, for example, they have the right to take sales proceeds when the building is sold. Bondholders. I'll explain bonds in an upcoming chapter. A corporate bond may be backed by a specific asset like a building or equipment, or it could be an unsecured bond, which is simply backed by the company's ability to pay. If you have credit card debt, most credit card debt is considered an unsecured loan backed by the cardholder's ability to pay. Talking about normal credit cards, not secured credit cards. Finally, if you own common stock, remember that you are last in line to receive assets if a company liquidates. Now, that situation is unusual, but companies do go bankrupt. A large profitable company like PepsiCo isn't much of a risk, but less profitable companies might be. Finally, proof of ownership. When you buy stock, what's your proof that you own something? Years ago, most stock certificates were issued in physical form. You actually got a piece of paper. Today, nearly all stock certificates are what they call book entry form, which is a computerized certificate. A registrar, an independent third company, is responsible for tracking every share and who owns it, and they issue stock certificates. So that's as far as we'll get on the basics of common stock. Remember that you can find all this information on my Substack page, which is here, and also on YouTube on the playlist that I mentioned. Thanks for watching.